Yeah, today we've got Alex Mond. Alex, where are you calling in from?
I'm calling in from Stockholm, Sweden. I'm working for RPM Risk and Portfolio Management.
Yeah, right. And you spent the weekend in Germany. You also play for a band, right?
I also play in a band. I was in Germany from last Tuesday until this Sunday.
And you do that a lot. You travel back and forth and play some gigs. And do you play some gigs
Well,
in Sweden too, or only in Germany?
yes, but pre-corona, I traveled a lot every month, but now it's more twice since then. So
Okay.
things have come down significantly.
So are you noticing that things are starting to pick up again from a Corona standpoint, or like what is the situation there?
Well, there are no shows, live theater, stuff like that in Sweden. We have like a 50 people max target threshold. So any event above 50 people is not allowed. And in Germany, they have over the summer adjusted it to, I think, depending on what kind of event it is, to 10 or 20% of the normal capacity.
Wow.
So, for
Okay.
example, last Friday we played a show at a venue with 400 people, and they sold only 60 tickets. And you have to buy the table, like at CTA conferences or awards. So you had to buy tables for 4 people or 8 people, and only allowed, only when you sit down at the table you're allowed to take off your mask. Otherwise, you have to move around with a mask on.
Incredible. Do you find it changes the vibe at the performance?
Yes, totally, I would say, but we're not going to do it again, I think.
Oh, really? Yeah, that's too bad. And things are really kind of ramping up there again, right? So it's not going to
Yeah,
get better in the near term, probably.
no, I think even these temporary solutions, they will be gone before the year end, and they were going to be too strict. No, like social distancing rules, and no concerts, no football, no nothing.
Again, yeah. Wow. Okay, so you operate RPM out of Stockholm, and that's your sort of full
Yes.
time job. And okay, so tell me a little bit about RPM.
All right. What I know is that RPM started in '93, and it is owned by our CEO and 2 other partners. And since then, we have been doing basically the same thing. We are a fund of fund, but a special one. First of all, we don't invest in funds. We only invest in separately managed accounts. So we have full transparency and daily liquidity to all the investments that we make in managers. Second thing is that we don't invest across the whole alternative investment strategies universe. We only invest in strategies that trade futures and exchange rate options. So basically, CTA strategy or systematic global macro kind of strategy. That's the 2 main things to know about us. Otherwise, we apply strategy balancing. So we invest in not only in trend following CTAs, but across the whole spectrum. But we have identified at this point 4 to 5 sub strategies within the CTA space that we invest across. And what I hear, I don't know, but what I hear is that what sets us apart from other people like Efficient or Epi, for example, is that we are quite active in managing the overall allocation to our managers, horizontally in terms of allocating between managers and strategies, but also vertically in terms of managing the overall trading level or the leverage if we see opportunities going forward, or if we think the environment for CTAs is too risky.
Right. So, what are you mentioned 4 or 5 categories. So, what are those categories, and how do you define them?
Well, the main category is trend following, although I have to admit that even this category has evolved significantly since 2008. So there's something that we call hybrid trend following or trend following plus X, because none of the new managers that started trading after 2010 is doing pure trend following these days. They're adding something else to the mix. That's why we call it trend following plus X or hybrid trend following. That's the first category. Second category for us is short-term trading, we call it, but that is technical, which is not trend, but we would call it directional technical trading, so contrarian strategies, mean reversion kind of strategies, that area. Third category is systematic global macro, or what we could call fundamental trading. So typical manager names there would be QMS from the US, or IPM from Sweden, or ADG from London, these kind of managers. So global macro, but in a systematic way. Fourth category, which we started allocating to almost 5 years ago, is VIX volatility trading. And the managers that we find there can trade the strategy directly through VIX futures or options-based, but neither they are exposed to volatility as a risk and reward factor.
Okay,
yes.
Yeah, no, go ahead. Sorry. Yep, thought you were done.
And the last category, which we just identified in the beginning of this year, is what we could call systematic commodity trading, which is typically your relative value calendar or intermarket spread kind of trading strategy. We've known some of the managers in that area for a long time, but as a group, we have identified them first this year, because this kind of relative value calendar spread trading has always been a part of other strategies, not on a standalone basis.
Right. And how do you allocate between the different types of funds? Do you sort of, you group them up, and then you allocate a certain amount of risk per group? And is that relatively stable, or is that dynamic through time?
I can let me share a slide with you about our investment process. I hope this works now. So this is our investment process here. You can see that, I hope.
Yep.
So basically at RPM, we have 3 decisions to make. One is which managers do we select, or which accounts do we close. That's decision number 1. Second decision is how much weight do we want to put on each sub-strategy. As you can see, this is quite an old slide. We haven't added VIX or commodity trading there yet. I need to talk to some guys here at RPM about that. And typically our weight to trend following would be 50% or higher to trend following strategies, and 50% or lower to all diversifying strategies combined. And there we have a quite even distribution between the diversifying strategies. Third decision we can make here is, as I said in the beginning, adjust the leverage, the trading level of the overall portfolio. So normally we move around between 120% of long-term target risk to 80% of long-term target risk. That's our fluctuation band, so to speak. And we take in on this slide 2 kinds of information sets, macro and market data, like everybody else. But given that we all have separately managed accounts from our managers, and we have quite an extensive database reaching back almost 20 years, we also make use of proprietary position data and sub-strategy performance data and so forth, and have built some indicators based on that help us with our decision making. So let me stop sharing the screen here.
So on the trend side, does a manager go into the trend style bucket by virtue of what they say they are, or do you have some other sort of style analysis or returns-based analysis that you conduct to ensure that they are mostly trend or complementing the trend sleeve?
All right. Well, the due diligence process, if that's part of the due diligence process, I would divide into 3 stages. First one is monitoring, where you try to achieve that you think you know what's going on in the universe, new managers, development of asset and management, what strategies have performed well or bad. Second part is manager screening. That is basically when we have a manager that we find interesting is on our watch list. We don't have a medium, long, or short list. We call it watch list. That's always 2 to 12 managers on their pair sub-strategy. And until this stage, I would basically go with what the managers say they're doing. So I would take their word. But once we get to the real investment due diligence or operational due diligence process, where we do the number crunching and check correlations, performance, crisis alpha characteristics, and so forth. There I would check how much trend following that actually is, or that what the managers say.
And do you try to balance the trend allocations along the trend term structure and across different specifications to trends? So sort of more the time series momentum, the moving average crossovers, the breakout strategies, that kind of stuff. What's the thinking around that?
Well, the breakout stuff, which has maybe a holding period of below 15 days, we would actually put that in the short-term trading bucket, because that can very much be a reversal kind of trading in the larger trend moves. Otherwise, in the trend following bucket itself, we are diversified across trading horizons as well. So we have, I would say, the most long-term manager that we have only reallocates monthly. That is something that we find very unique among the trend following managers. And we have a manager that is very short-term with a 20% trading horizon. So everything in between there, and most of the managers also with multi-time horizon trading. So we're set up across time horizons, I would say. Yes.
So the manager that trades, they trade monthly?
Well, they have a reallocation on a monthly basis, but they have risk management, of course, on a daily basis, if anything goes.
Interesting. Okay. And when they trade monthly, is it the same day every month, or do they trade like 1/20th of their portfolio every day? Oh, wow. Okay. Interesting.
Yeah, and we like unique managers. It can be unique good or unique bad, but in the mix, even unique bad can add something can add value to the overall portfolio. So as long as it's something that contributes to keeping diversification within the portfolio high, that's something that we like.
So one thing within the trend, I've always been sort of curious, and I've chatted offline with Murat and some of the other people at Abbey, for example, that run fund of hedge funds or fund of managed accounts for in the CTA space, and I always wonder just how much diversity can you get from multiple managers in the trend space. I mean, there's only so many ways to define trend and so many different time horizons for look back, shapes of the look back structure that you can use. I mean, we've done some decompositions of, for example, if you take everything from 5 days to 300 days, time series momentum, moving average crossovers, double moving average crossovers, triple moving average crossovers, breakouts, etc. And you examine the time series, and you can do this with just like Brownian time series or with real time series. And what we find is that there's really, you can decompose and capture 80 or 90% of the variance of the entire trend space with like 8 different trend specifications. So I always wonder just how much extra diversity do you find you can get by adding an incremental trend manager?
Well, the best example is to look at real performance, which I think is during this year's Corona crisis. And I think it was also the year 2019 when there was a big, rather large dispersion across trend following on a yearly basis. And my view, or our RPM's view on this, is that there are so many degrees of freedom you can play with in your setup of the program that it makes the managers quite different from each other, even if the underlying risk factor they're trying to exploit, time series momentum, is the same, right? So
Yep.
if you, for example, if you have fixed sector allocations or you have dynamic sector allocation, makes a huge difference. One trend follow manager we have doesn't trade any commodities at all. Another manager has actually, by design, almost 50% of the exposure is commodities. So that makes a lot of difference. And the same with the time horizons. You can have fixed time horizons, or you can have dynamic shifting of your models towards different time horizons. And once you add what we call hybrid trend follow managers to the equation, you can have all kinds of performance. If you,
once you add in other factors, you mean?
Yeah. So, example, a manager that we were invested in until last year was John Street. And they have 1/3 of their trading is relative value calendar commodity spread trading. So that definitely gives a different profile to the other trend following managers.
Right. Got it. And out of the 5 I think there were 5 sleeves. Let me go through them. So there's trend, short term, fundamental,
VIX, commodity.
VIX.
Yeah, 5.
What was the 5th one then? That was 4.
Systematic commodity.
Systematic commodity, right? So out of the 5 sleeves, I know like obviously trend has had a very difficult 5 years. Arguably, most trend has had a relatively difficult 10 years. Any strategies stand out over the last 5 or 10 years that have sort of made up for the challenges for trend?
Trying to generalize, I would say short-term trading, or which has, not in absolute terms, but in terms of portfolio protection, has shown its worth during the VIX events 2018 and again this year. So that is a strategy that we are very happy with. On the other hand, the short-term trading universe is so diverse within itself, so many different kind of strategies. In the midst of the Corona crisis, we had a manager up 32%, another manager down 28 or something. So at the same volatility target, so that can be even more heterogeneous than the trend following block.
Yeah, no doubt.
Otherwise, in the VIX volatility, I would say in the VIX volatility trading space, there is the most going on in terms of new managers and new interesting ideas. I would say not 2 managers I've met since the last 3 years are doing the same thing in the VIX volatility trading space. That's where really I feel there's currently the managed futures creativity hotspot, so to speak.
Right, got it. And how are you observing that trend managers what do you call them, hybrid trend or trend X or hyper trend or something? But what are they adding typically, or what are some of the things that they're adding to the mix? And I guess they're adding it because trend itself is just not quite reliable enough anymore on its own for a single manager to be able to generate the profit profile that will attract investors.
Well, generally, the whole idea of this hybrid trend following is the same as with the multi-strategy managers such as QMS, for example, or is to smooth overall performance, right? That's the whole point, to overcome the drawbacks of a pure strategy. And in terms of trend following, you can choose to either smooth your whipsaw losses during times where there are no trends, or to try to counteract the give back losses when there is a major reversal. So, and different hybrid trend following managers have chosen different paths, so to speak. And the managers that we have now, I would say, one is trying to. There will be less down in February and more up in March because they are profiting from the reversal. And another hybrid trend following manager will be less down during whipsaw periods, like, for example, this summer.
Right. And so what are some of the other edges that they're adding to the trend following sleeves to increase stability?
Through this kind of diversification within the trend following space, they are in the gray zone, for example, between short-term trading, what we should call short-term trading, and trend following. And so we basically have this whole cascade of trading horizons that we cover. So if we think the markets are turning, or our portfolio is vulnerable to reversals, we will allocate more to the short-term trading and the hybrid trend following space, and less to the standard trend following managers. So it's a whole.
Okay, so yeah, so that speaks to your sort of the active role that RPM plays in the management of the portfolio. So why don't you go into that in more detail, because I think that actually is a very unusual dimension of RPM's business, right? Where you're very active in trading, allocating risk between managers and in managing overall portfolio risk.
I want to walk you through 3 trading examples, which are all taken from the great Corona crisis, because that's the last major crisis, and a crisis where people ask, where is my crisis alpha, typically. And the first example is going to be more complicated. Therefore, I have to take a little detour and explain some of RPM's indicators that we use. And the other 2 examples are simple position management where we think something is out of the ordinary, not acceptable in terms of portfolio concentration risk or in terms of aggregate exposure. So we have several indicators, but one of the most important indicators that we use is the so-called coordinated market sell-off indicator. And here on this graph, what do I mean by coordinated market sell-off? Reversals are regular characteristics of financial markets as they move along from one equilibrium to another. But what we call a coordinated market sell-off, you might also call VIX or correlation spikes. We define a coordinated market sell-off as a day where RPM has a major down day, so we lose more than 2 standard deviations, and at the same time, approximately 1/5 of all financial markets that we monitor also have a volatility spike of more than 2 standard deviations. So it's a real correlation and volatility spike that hurts our performance. And we started the research at the first sell-off here, China sell-off on February 27th, 2007, if anyone remembers that one. Then we had the onset of the subprime crisis here and the quant sell-off in August 16th. We had our indicator was up and running by mid-2008, protecting us a little bit from the oil sell-off 2008 on July 17th and so forth. So normally these sell-offs or these spikes, performance recovers quite quickly, but we try to, if we can cushion our performance during these sell-off days or make it less hurt, then we can add a lot of value on top of our portfolio. And the indicator itself is quite simple. We do a daily probability regression analysis, and then we mix a lot of data with a lot of different data frequencies. So the monthly and weekly data doesn't change on a daily basis, obviously. So we have macro data in there, like macroeconomic activity or central bank activity. And the idea is the more the fundamental variables change, the less likely there is a coordinated market sell-off, because when fundamentals change, then markets have to adapt to the new market environment, and we will be moving to a new equilibrium. If there is no fundamental information, then there's more room for speculative and fast money flows in and out, which are more likely to occur during these volatility spikes.
Interesting.
We also have market data in there. For example, we measure all the CFTC's futures data. They have a categorization for commercial and non-commercial positions there. And the non-commercial players in the futures market normally are banks or hedge funds. And it's basically the same idea there. If there's more speculative, non-commercial money flowing around in the futures market, then it's more likely that we have these kind of sudden sell-offs than if only Shell and Cargill are trading.
So how are you measuring that? Using the
That's just
CFTC, for example.
Well, you can just download it from their server, the positioning, and then you can net it out, and then you have net position, net spec. Across
many markets, or are you looking
all the markets that are on the CTC. So. And then we have daily proprietary data, which we can only have due to our usage of managed accounts. And there we have different kind of concentration risk measures. For example, measuring the correlation between our trend following bucket and our diversifying strategy bucket. Or, for example, measuring the similarity of positions between different trend following managers. And again, the idea is there. If everybody's doing the same thing, if short-term traders and VIX traders and trend following managers are profiting all from the same sector or at the same time, then we don't have enough diversification in the portfolio. So this is dangerous, right? We do this on a daily basis, and we define a risk above 20 as high. And this is, and in the graph is the last 5 years here. So the orange is our daily out of sample estimate of a coordinated market sell-off risk. And the vertical, I would call them pink lines, are when we have actually seen these events. And as you can see, we don't get them all, but we get some and we act on them. Normally we reduce our risk by 20% if we have high COMASE risk above 20%.
And that is generally the threshold. So 20% in either direction. So you can be, if I recall, you can be 120% of risk.
No, it can only the output from a propagation can only be between 0 and 1.
I see. Okay, but there was some model that you used to be able to increase your risk above 100%, right? But it must not be this indicator. Okay, gotcha. And
thank you very much for doing the introduction to my next slide.
Pleasure. This is what happens when you do your homework. You get ahead of the guest.
All right. Yes, no problem. All right. The other indicator that we use is called the market divergence indicator or index. It has been in use since the mid-90s in different versions. So it's been updated regularly and extended and researched over and over again. But in a nutshell, it's basically our way of measuring time series momentum across futures markets. Time series momentum is the term coined by Moskowitz et al. In their seminal paper from 2012, and to set it apart from cross-sectional momentum. And basically what we do is we relate the daily absolute price changes to the underlying volatility. And we do that for many different markets and across many different time horizons. So we basically, for example, we have the absolute price change over a 5-day look-back period, and then the underlying price fluctuation for 5 days, for this 5 days period. We do that across all futures markets, and we go all the way to 250 days look-back period. And as you can see, when this indicator is moving up, then we have time series momentum in the marketplace. We have trends across different markets. We have trends across different time horizons. And as you can see in this graph that we had plotted there, the SocGen CTA index, that is normally when the CTA universe profits, when time series momentum is increasing. What goes up must come down. So once we have seen a trending environment, what to expect going forward is that these trends will reverse or disappear. That is normally not a good environment for trend following managers. And so we use this indicator, how you call it, vice versa. So if this indicator is very low, we see it as an opportunity. So we normally consider increasing risk, something that we actually did now since August. And if this indicator has reached a local maximum, a peak, then we say, okay, this current trend period is over. We have to reduce risk. And what normally happens is that this coordinated market sell-off indicator and the MDI indicator signal a risky environment at the same time or around at the same time, and that would make us reduce risk significantly in the portfolio. And so this is our interactive website for our clients, where you can see daily fact sheets and positions. You can do all kinds of scenario analysis where we post our research, but we also have a page for our indicators. For example, the coordinated market sell-off indicator, which we call COMASE. And if I go back to February of this year, you can see how it is picking up, and you can see on February 12th that it reaches the 20% threshold here. Mm-hmm. So on February 12th, we decided to decrease risk across the portfolio by 10%, but especially by reducing the allocation to trend following managers. So that was maybe a week early, but as I remember correctly, the sell-off started on February 21st, because that was my birthday, and I was at the carnival in Cologne. So
your birthday is February 21st? My birthday is February 21st.
All right, so you had to, okay, all right, cool.
That is wild.
All right, so that's where we initially started reducing risk across the portfolio. And now let me walk you here. You have the MDI, and let me take you back. I think it was mid-March, I think the 10th here, and you see in the second week of March 10th, you can see a major spike in the MDI index here, the orange line just jumping up. That was the fastest increase in time series momentum that we have on our records. That was the week after Trump banned travel from Europe, and the equity markets just fell off a cliff. So these two indicators made us reduce risk even more. So we had 80% target risk on. Trend following was significantly below its long-term average levels, and then we had the bounce back in late March, obviously. But now let's fast forward here to this index to mid-April. In the COMASE, you see we had two of these sell-offs, obviously, which were correctly forecasted. And now you can see that the coordinated market sell-off risk has dropped down significantly below its 20% threshold. At the same time, if we fast forward also to mid-April here, you can see that also the time series momentum indicator, the MDI, has come down to long-term average levels and is sounding the all clear, both indicators. So we took back risk to normal levels officially on April 23rd.
Gotcha.
And overall, this risk reduction, this tactical risk reduction, had added 1.4% to overall performance. So otherwise, our portfolio would have been down more than it actually was. So that was quite a successful intervention by us, I would say. And we've done the same thing before VIX Magellan, I think it's called, in February 2018, and so forth. So,
love it. So I'm sure people are going to be curious, where are we today with those indicators? Are you able to share?
All right, indicators.
It's a great tool. Did you build that internally, or did you?
Yeah, of course. Everything. That's all. Everything. That's before you got those solutions just to buy them.
What did you build it in?
This. I think we have had this, the first version of this, 15 years ago.
Okay.
So currently, the MDI is at its long-term average, just around 1. Has been taken up this month. This month is positive across portfolios and almost also across managers here. So there are some trends, but it's not a major trend environment yet. We believe, we had a mail out 2 weeks ago. We believe that in election years, normally, the best period for CTAs is the fourth quarter, but it's significantly different during election years. In election years, you have all the trend environment that you see normally in October, November, December, concentrating to after the election is over. So we expect trends in either direction to pick up significantly after November 3rd or some point at November.
Right. Okay. Yeah, that makes sense.
And coordinated market sell-off risk here is ultra low, and that is because we are, you can see it here, but I can tell you is that we are very diversified across managers and sub-strategies. We basically have no net US dollar exposure. We are long bonds, but there are managers with significantly short bonds exposure as well. So it's diversified away, so to speak, the risk here, sell-off risk.
Gotcha.
All right.
What else are you working on? Have you added any indicators in the last little while, or have those been in place for many years and they are sufficient, and you're not really seeing any need for new ways to view markets given the changes in behavior?
Well, actually, good. Thank you for asking. Actually, if you remember the coordinated market sell-off indicator picture I just shared, it shows you that we missed 2 sell-offs in October 2018.
I did notice that.
All right. And that triggered a reevaluation and an update of the indicator. And we found a better input factor than we added a new input factor, and basically we measure the portfolio's US dollar bond position versus its US dollar equity position.
And so when they're
being
both
short
high,
bonds
or
and
how
short
does that
equities
work?
at the same time is not a good thing.
When you've got high exposure to equities and bonds at the same time, you say?
No, short bonds and short stocks. That's not good.
Oh, I see. I gotcha. Okay.
So that's been added. It's not added to our website, but we run it internally, and the indicator behaves very different from the existing one. So we are still evaluating. The new one would have missed the February sell-off, for example, but would have taken the one in October. So we are thinking about a combination of the two, but we are not there yet. So we have to evaluate.
Yeah, well, you want diversity of signals, right? Some of them are going to pick up on different types of coordinated market sell-off environments, and others will pick up on different ones.
Yes.
So, I mean, that's kind of ideal. What has changed in terms of your manager identification and selection process over the years? Are you doing things the same way right now as you did 5 years ago, or how do you think about identifying new managers? What are you looking for when you're monitoring them for a while? What causes you to pull the trigger?
All right. Well, we have to differentiate between pre and post Corona, obviously. The monitoring process is still the same. We have, on a weekly basis, I get an email from our database, telling me if there's a new addition to the Barclay Hedge database, or Barclay CDA database. That's where most managers report to.
Yep.
And if there's a new entry, I normally read the trading strategy description. I normally do some rough correlation analysis, and then I classify the manager by one of 20 sub-strategy categories that we have.
And is that qualitative based on how they describe their strategy, or are you running? I guess you don't have much data, so.
No, but if you're, let's say, if you are a trend following manager and you are down in certain month when everybody else was up, then something's wrong, obviously. But normally I go with a description there.
Okay.
But sometimes, for example, we have more categories there. For example, if a manager, which I've never met, is saying something, they're doing something systematic in currencies, I don't know if this is trend or short-term trading. So they get the category systematic FX trader, for example.
Okay. Gotcha.
And the second step that we do is we get a ranking on a monthly basis, the top 20 performing managers, and 19 of the 20 we know have been invested in or are invested in or decided not to invest in for several reasons. But if there is a name that we have never heard of, then obviously it's my turn to pick up the phone and call that manager and get to know them and put them on a watch list. So that's the second part of the monitoring process. And once we have the managers on the watch list, we do the full due diligence always in groups, because we also, I forgot that to mention at the beginning, we focus on smaller and younger managers. So what we call evolving or emerging managers. Mm-hmm. And our experience has shown that we cannot afford to do one due diligence process per manager. We always cluster them together in groups of 4 or 5 managers, and then we do the whole due diligence process, because those managers sometimes cannot deliver all the data that we need, or not in the time that we need. And so once the watch list is filled up with, let's say, 5 to 8 names, I make a presentation to the investment committee, and we discuss each manager in length. And of course, I have a conference call with them before, and I tell them about my experience with the manager, or I've met them in person. And then they decide the 4 names which to do the full due diligence on. And pre-Corona, there was always also conferences like the MFA or Alpha Metrics a long time ago, where you actually met people, and sometimes you met managers that did not even show up in the database because they never had not started reporting or anything like that. These kind of events have totally stopped. So it's going to be hard for us to find new managers if they don't start reporting. We have some contacts at our brokers, at SocGen, for example, or the other cap intro teams that make suggestions to us because they know what we're looking for. But I think we're going to miss those conferences in the long run going forward.
Yeah, just to be able to be introduced to managers that are a little bit off the beaten path and off, not reporting to the typical databases and stuff. Yeah, that makes sense. So, but obviously, there's what goes into the operational due diligence. I mean, you've got the sort of you get the basic boxes you've got to tick, I guess. But then, for the managers that tick all the general boxes in terms of operational integrity and approvals and multiple custodians and all of the sort of operational and compliance things. What else are you looking for that differentiates a manager that says this is somebody that I want to look more closely at?
Well, that takes us back to the investment due diligence because we have two different processes. So what we find, the operational due diligence is only to tick the boxes, as you said, do reference calls. On-site visit, now we're going to do Zoom or MS Teams, on-site visits, obviously, verifying the track record, stuff like that. That's only to tick the boxes. And we are, as we only invest through our own managed accounts, the operational risk is quite limited, actually, in the investments that we make.
Right.
From the investment part, what we are looking for in a manager is, performance, diversification, and uniqueness. That would be my three words to in a nutshell. So obviously we want absolute performance. If you have a track record that has no down months, then something's wrong. Obviously, so we have to understand where the performance comes from, and we have to understand the weaknesses also. And that's also why we only invest in systematic strategies, because we want these strengths and weaknesses to be repeatable and reliable. So we, as a allocator, can add value on top of that.
How do you overcome the issue of a manager who is truly I mean, it's a strange relationship, because for much of our evolution, for example, we really were not doing anything that was really truly novel, right? Like you could look through our performance and see, okay, yeah, they've got allocation to trends at these tenors, and they've got allocation to carry, and if you've got some more esoteric factors that you can perform some style analysis on, you might also observe that we've got some skewness exposure, some seasonality, that kind of stuff in there. But we were very open about it. Like when we're going, you've been through our deck, you see, we're very open about what we're doing. But as you get into managers who are doing something different, it's a different kind of conversation. The manager doesn't want to disclose, and the performance itself is not enough to give you any sort of real confidence and significance. So how do you overcome that?
Okay, let me rephrase here. Uniqueness. For example, what you just described, we have over 100 manager contacts per year. What you described is pretty unique in the manager universe that we meet. The broadness of your approach is a unique factor in itself.
Okay.
So that puts you apart from other managers, multi-strat managers I have come across, for example.
Right.
It can be other factors for trend following manager can be, for example, a manager, I don't know names here, but their first position is the strongest trend signal, obviously. That's the largest position. But the second position is not the second strongest signal, but the second position is the one that is most diversifying to the first one.
Right.
It doesn't have anything to do with any trend signals. And hearing that makes total sense intuitively, but why not? Of course, then it's basically cross-sectional hedging within your trend following system. Doesn't sound like rocket science to me, but at the time when I met that manager, that was over 4 or 5 years ago, that's the first time I've ever heard that from a manager, describing it that clearly and that plainly.
Right.
And that was a unique factor, for example.
Right.
So it doesn't have to be any rocket science or anything like that. It's just...
But it's different.
Yeah, it's different.
Yeah. Yeah, so it's sort of analogous. It's sort of a heuristic way to create to maximize exposure to trend while also simultaneously maximizing diversification in the portfolio and not getting overly concentrated. Yeah, I like it. Yeah, I guess what I'm getting at is
if I can make another example, for example, if you want.
Sure. Yeah, great.
Another trend so another long-term trend following manager has which basically we try not to get whipsawed. That's why we use long-term trend following for entry signals. All right, fair enough. Heard that before. But at the same time, we create some asymmetry for getting out. So there we have a 99 times 99 matrix over the different trading horizons. And if this matrix has more than 51% telling us to get out, then we close the position. So basically, they're faster on the way out than they're on the way in.
Nice. Yeah.
Has its strengths, has its weaknesses, but it's definitely a unique setup.
Right. Got it. And so you want them to be doing something a little bit different. And then you're observing the performance. And this is always the tricky thing for me because, it's easier to identify managers who are doing something wrong.
Yes.
But I think it's much harder to identify or to distinguish between managers who are doing something different and managers who are just luckily exposed to some systematic risk that they're not consciously aware of, but that can change at any moment and completely and render their strategy ineffective, right? How do you?
Yeah.
This is the challenge with the returns based selection criteria, and I'm just wondering what your thoughts are.
Well, we have managed accounts again, and we have a real-time performance system here as well. So we can, during the Corona crisis, we checked every quarter, but normally we check maybe 3 times a day or something. We update the real-time performance. So it's we see on a daily basis what the managers are doing and what contracts they're profiting from, and of course we are not perfect, and there are no guarantees. But if there's anything out of the ordinary, or if we observe a style drift, or we question why the manager has performed the way they have, we schedule a conference call, get an update, or we do some reanalysis. Or in the most simple terms, if something seems off, we just set the allocation to 0. That has happened this year 3 times actually already. So then it's about intervening quickly to protect the overall portfolio, right?
Yeah, right. No, I like it, but I wasn't really referring to that. I was more so just as you are deciding on managers to allocate to it. You're observing performance. Right. And as you're observing performance, if there are major outliers, now you've got reasons to ask questions. Negative outliers, both outliers, I think, are reasons to ask questions. But if you just have a manager that looks like it is performing well, there are no major outliers. It's how do you think about distinguishing between skill and luck?
Well, we actually also have position data on a daily basis, so we actually react on that too if you have outliers there. I could give you an example
in terms of excess concentration, or
yeah,
they're only making money in one market, really, or that kind of stuff.
Yes, and then we would intervene as well. I can just. Do we have some time? I share.
Yeah, go for it, please.
This graph is less complicated than it looks. So. That's our position data for the different managers in one of our portfolios on March 25th. And there you have the different the sectors, FX US, FX Asia, commodity metals, commodity softs, and so forth. You have the overall risk measured in the red line there. And it is always compared to the green line, which is the long-term average sector exposure. Mm-hmm. And what you can see there is that the risk in metals is sticking out, and very much so. Then you have the columns there, and this is how much the underlying managers contribute to the overall risk in each sector. So that it also helps you to see where you can find diversification, or if the portfolio is very concentrated. But on that day, the main thing that we were concerned with was that it is one manager who's basically driving the overall metals exposure.
Mm-hmm.
And
so did you inquire with that manager? Was that a cause to reach out?
There was, of course, a cause to reach out. There was also a cause to reduce the allocation. It was actually the manager profited actually from that move. So that was, but from our risk management perspective, from a manager of managers, this allocation was prudent to reduce risk in this sector.
Right.
So,
okay, yeah. So who's a typical client of yours, and what are they looking for?
That has changed dramatically since I started. When I started 15 years ago, we basically did white labeling CTA solutions for Japanese clients for their structured products, could be banks or corporate pension funds. Since this kind of investment vehicle has, due to the low interest rate environment, has not there's not demand for that anymore. Mm-hmm. So since 2010, 2013, two different portfolios, we've launched our own flagship funds where actually our name is on there. So the RPM Galaxy CTA fund and the RPM Evolving CTA fund. And their clients are mostly from Europe, Sweden, German-speaking Europe, Netherlands. And there we have family offices, private banks, here in Sweden, also some corporate pension funds.
So what's the difference between the two funds?
RPM Evolving is aiming at smaller, younger managers. We find that these managers have possibly some outperformance, but they're definitely even more diversified among themselves than managers of different sub-strategies if they are big. And Galaxy is a portfolio of big managers, so your typical CTA names.
And what are clients looking for? Have the needs of clients changed over the last little while? Has the COVID crisis changed people's expectations, or
that's something that we're always happy if the CTA industry measured as the Bar Clippy Top 50 or the Separated CTA is doing well, because that means the whole industry is doing well, and most of the money is unfortunately in the big names, otherwise there wouldn't be the big names. Mm-hmm. But what we have noticed since at least the last 3 years is that the smaller managers significantly outperform the larger managers, which basically means the people that are interested in our portfolio solutions they have already CTA allocations. In Sweden, there are 3 names basically, but and they're looking for something else to diversify from this one manager that they have and that has disappointed them in the last 3 or 4 sell-offs.
Right. What do you think it is about emerging managers that allow them to maybe generate a little bit more excess alpha?
Well, I would say 20% of the new managers are the future stars. There's new talent out there. They try new ideas, which maybe if they had worked at, AHL before, all their research ideas going into this institutional process of approving or not approving, and it takes forever. They get frustrated, start their own shop. For example, we were invested in ADG until they had 1 billion, from 120 million until they had 1 billion. We were invested in John Street, as I said, when they had below 100 million, actually, until they now have become too big. So there are future stars or future big names out there that we are looking for. I don't know if it's a virtue or coming with the fact that there's only often 2 or 3 people running the show. There is that the strategy are more pure. So they're exploiting more like one risk factor, not trying to exploit all of them. So that's can also be an advantage from a portfolio's perspective. They run at a higher volatility, which makes more sense from us. We have currently 30 managers in the portfolio, and we have a target volatility of 15%, and it's actually quite hard to get up to the target volatility if you have managers that are so diversified among themselves. So a good thing is if they have high incoming volatility, and some of those managers that we have, we would never invest in on a own basis, given the, if you have 30% or more volatility, that's nothing, you want as an end investor, so to speak.
Right. I was wondering if it maybe also is due to the fact that they can trade faster signals, and they can trade in more frontier markets and less liquid markets, trade a little further out the term structure. They're able to take advantage of things because they don't need the same amount of liquidity that larger funds do. That's
true for most larger managers versus smaller managers, but not for all. For example, a manager called ISEM they make a thing out of it to really be diversified and have really high commodity exposure and go into what we would call niche commodity markets as well. So you have the big guys doing that as well. I can imagine that it is an advantage if you are in those markets and you're a smaller player, that you don't leave a footprint or so, and that you can be faster in and out with less slippage and stuff like that.
Right. Excellent. Well, look, we're coming up on an hour, and we covered a lot of ground. Did I miss anything that you wanted to make sure that you had a chance to talk about?
No, I'm fine. I think I'm good. Talked a lot.
No, that was great. All right. Well, I appreciate it. You sharing your process and a little bit about RPM, and I'm sure we'll have a chance to connect on similar topics in the future. So what time is it there now? It's you're into the evening, right?
It's 4:45 in the afternoon. It's getting dark here.
Oh, it's time for a pint. All right. Well,
it's Tuesday, so no.
Oh.
I'm going to wait till Thursday.
All right. Got it. I didn't, I wasn't aware of your schedule, but that sounds prudent. All right. Well, look, Alex, thanks so much for sharing your insights and for spending some time with us this evening. And I'm sure we'll chat with you soon.
Yes. Thank you very much. Thank you for having me.